Well, I think angels in particular are kind of the lifeblood of the ecosystem. Angels are the ones who the founders come and talk to, and they are the people who help them tell their stories better so that when they speak to VCs, they can do all the things that we were talking about earlier in this conversation. And the very best angels are incredibly well networked and have kind of really crazy imaginations, so they can talk to a founder who really just has a good idea and has no idea what to do next, and help them and kind of see their vision of the future and then help connect them to tons of other people.
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 169 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors and operators to unpack their journey, lessons and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of Jax Vullinghs, partner at AirTree Ventures and our guest for this episode. Jax has had a fascinating career journey to date. She studied history at university before joining the world of investment banking at Merrill Lynch. After 2.5 years, she decided to join an early-stage startup called Listable that later rebranded to Kalo. Kalo went on to receive significant funding from leading venture capital funds around the world. In 2018, Jax moved to Australia and joined AirTree, one of Australia's leading venture capital funds, where she now serves as a partner at the fund. In this jam-packed episode, you will also hear why I'm personally over the moon about having Jax join the Playbook Angel Network, the podcast's new Angel Syndicate, as an advisor. We'll be investing in early-stage, high-growth technology startups and are delighted to have Jax in our corner. In this episode, we covered a wide range of topics, including how Jax and AirTree assess seed-stage opportunities and determine a valuation, what makes companies valuable over the long term, AirTree's investment committee process, the fund's bet on Milk Run, the important role of angel investors in the ecosystem, and much more. In this episode, Jax also shares how numbers can help tell your story to investors, and that's why I'm excited to partner with Sender. I run all of my personal and business accounting needs through them and can say from first-hand experience how great it is to have a dedicated team to help support me in this area. Sender is more than just an accounting firm. They have a dedicated focus on founders, funders, and startups, and can help you with everything from managing your tax, balancing your books, and even helping with your exit strategy. To find out more, head over to sender.com. And whether you're taking on external capital from great funds like AirTree or bootstrapping your way to success, you'll want to make sure that you have the right legal infrastructure in place. LawPart's legal advice plan gives you access to lawyers on demand for one low monthly fee. You can create documents, sign online, and even have a lawyer on call to help with any legal issues at a fraction of the cost. They've helped save Australian businesses over $100 million in legal fees and are offering Startup Playbook listeners up to 20% off their most popular plan. To get access to this exclusive discount, head over to lawpath.com/playbook. And finally, if you're an early stage startup looking for the right technical partner for your business, you'll want to speak to the team at Dovetail Studios. On top of being a renowned product development partner for startups like Afterpay, they also operate a VC fund to invest in early stage companies that go through their Venture Studio program. So if you're an early stage non-technical founder looking for a team to help supercharge your success, head over to dovetailstudios.com. With that out of the way, and without further ado, here is my interview with Jax Vullinghs. Hi Jax, welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
I'm delighted to be here. Thanks for having me.
Jax, for those people who may not be as familiar with you or your background, do you want to share a little bit about your story and what got you here today?
I grew up in the UK. You might be able to tell from my extremely thick accent. I grew up just outside of London, went to uni in Cambridge, studied history, and then made the very obvious next jump to work on the trading floor selling equity derivatives at Citi and then at Merrill. I spent 5.5 years doing that, and it was kind of an amazing experience of learning finance and economics and in practice, but kind of knew that's not what I wanted to be when I grew up, and really wanted to be an entrepreneur myself, but didn't really know what that meant. My family had super stable jobs and I'd never really met any successful entrepreneurs when I was a kid. So I had this kind of feeling and impulse, but I didn't really know what to do with it. And so I went and joined a B2B SaaS startup at seed stage called Listable that then changed its name to Kalo over time. And spent a few years there just having a great time, incredible team, huge vision. We raised a Series A round from some of the best investors in the world. We expanded to the US, and it was just an incredible journey. I was chief of staff there, but really doing all sorts. Starting teams, hiring people for them, working on go-to-market strategy, product strategy. It was brilliant. And then Decided to make the big leap to move to Australia in 2017 and thought I'd start in VC as a way of figuring out what company to join or go and build, and then fell in love with VC. So I've been investing at AirTree for about 3.5 years and joined the partnership in summer last year. And I invest in kind of all sectors. We focus mainly on seed, so investing at first checks into companies, and then we have a kind of big follow-on fund that invests in future rounds for companies that are growing well.
Fantastic. And obviously, there are so many parts of your journey that I want to unpack, and I'm sure we'll make our way through this episode. But one of the things that I really love about this podcast, and just things that I love about this space, is when I was growing up, similar to what you sort of mentioned about not necessarily having or being surrounded by other entrepreneurs, I just felt like I was this black sheep that was just going way out of the ordinary and kind of making these really aggressive career changes, which didn't really make a ton of sense at that time, but somehow made a ton of sense to me. But sort of moving from doing a history major to Merrill Lynch, ultimately into VC, what were those sort of decision-making points for you? And I guess what sort of gave you the confidence or the conviction to sort of make those pivots in your career?
Confidence is a big one. I don't feel like I made those decisions from a point of confidence all the time. With the kind of, I guess, the first one from history to banking, I think when I was at university, I really focused just on my degree and on sport. And so I was pretty heads down just for the whole time I was there. Kind of lifted up my head in my last year and realised that I needed to get a job and didn't really know what the jobs were. And so ended up just speaking to a ton of my friends. One of my friends had just done an internship on the trading floor at JP Morgan and said, I think you'd really enjoy this. It's really fast paced and there are tons of smart people. And so I decided to put in an application for 10 investment banks, got interviews at 2 and got a job at 1. And really I was kind of a random hire for them just to see if it worked. I think I went into kind of a sales trading role, which they'd hired tons of kind of maths and economics grads in the past who were really great technically but not very good at building relationships. And I think what they wanted to try and see was, can we hire someone who is better at kind of building relationships with people and maybe teach them the kind of economics and finance side of things. So I was a bit of a test case for that. And that was good. It was great. It was definitely a baptism of fire. I spent a lot of weekends reading options theory, but I got there eventually. And then moving from banking to, I guess, startups and then startups to VC, it was really hard for me to leave banking, largely because on paper it is such a good gig. I was working 11-hour days, which is pretty reasonable, I think. I was getting paid very well. By all accounts, it really was what success looks like. I was good at it. Really was like, what you think success looks like. And, when I would talk to my mum, I'd say like, oh, Mum, I just don't think I'm happy. Like, these people don't feel like my people. I feel like I'm not learning as much as I used to. I feel like I'm really just moving numbers around for a living. I think there should be more to this. And I was, starting little companies on the side, doing things. But, my mum was telling me I was crazy. At the age of 26, I was earning what she was earning in her 40s. And so I think it just took me psychologically a long time to get over that. And in the end, really, it was kind of a panic. I just have to do this now. So I'm going to walk out today. Which isn't how I recommend people doing these things, but it's how it happened to me.
What about sort of Listable or kind of startups in particular made that the right next step for you after leaving banking?
I left and then I took a few weeks to kind of figure out what the next step was. And when I was looking at companies to join, I was really looking at, what's the company mission and can I get behind it? I ended up cold emailing Listable and essentially just saying, hi, you don't have any job roles available, but I'd really like to work for you. Are there any jobs? And they were kind of found it funny and interviewed me and kind of hired me without a job description to just do stuff, which I think is very possible at seed stage when you really just need a lot of generalists who can do things. It was kind of the team and I think the mission and the vision of the company that really got me excited at the start.
Yeah. And obviously you sort of mentioned that Listable went on to raise Series A by some of the leading VCs. And I know through sort of other conversations you've mentioned that, potentially the company raised too much money too soon and there are sort of downsides of that, which, I think for a lot of founders doesn't seem like that difficult of a problem to have in terms of having too much money. But do you mind sharing from your experience, what were some of the lessons or outcomes from that experience that you now take into investing?
Yeah, so I think we had this incredible team, a really amazing market opportunity. We had competing term sheets from Axel and Valar. We raised 11 in a Series A, and then the investors wanted to put in another 14 about 6 months later. And so we had very quickly $25 million in funding. And we were pre-product market fit, really. Like, we had early traction and we had some great logos. We had some metrics that looked really good, which was why the investors wanted to invest so much money. But I think if we were true to ourselves, we didn't really have a good sense of product market fit. There wasn't really a business machine that we understood yet. And by taking that money, I think it would have been fine if we had put that money in the bank, stayed really lean, and just refined our way and iterated to product market fit. But I think at the time, we took that money and poured it into a model that wasn't perfect yet. And we felt a lot of pressure to grow extremely quickly because investors had given us all this money. And so we needed to grow really, really fast. And we were all kind of doing it for the first time. We probably wasted a lot of that money pushing on a machine that wasn't really a machine yet. It then put us in this position where we were kind of burning through that money and not making the progress we really needed to be able to justify the valuation we already had, let alone grow into a new valuation. I think that just puts a huge amount of pressure on a company very early on, unless you can be incredibly disciplined and just put the money in the bank and continue to operate really lean and small. It can create the wrong incentives and lead people the wrong way.
Flipping that in terms of advice to founders now, the last 12 to 18 months have been really interesting, where towards the end of last year, it seemed like capital was freely available at really high valuations for companies. And, speaking to a lot of founders now that are finding it really difficult to raise and have probably lowered their expectations in terms of both the amount and the valuation that they're seeking. Do you have any advice in terms of how founders should think about how they either structure their raise or how they sort of think about valuations, especially given the current market?
I wouldn't have any kind of specific different advice. I would always say, think about what major milestones you want to hit for your next round. Think about what you need to do to be able to get there and the money you'll need to be able to get there, and kind of triangulate that with the level of dilution you feel like you would be willing to take. And there's no kind of perfect art or science to it. But really it's kind of take an amount of money that you think will help you with buffer get to the next major milestone that you want to for the company.
As you mentioned, AirTree invests in seed stage companies where often there isn't a ton of data points, and it's really sort of difficult to gauge how big that potential market could be, especially if there is something new and novel that the startups are taking to market. How do you sort of think about, if you're offering term sheets or if you're offering to lead, how do you sort of think about structuring that or analyzing that to come to a point to valuations that from an AirTree perspective you're comfortable offering as a potential term sheet?
Yeah, seed stage is really hard. From a valuation base, from a market basis, every basis. I think when we're looking at seed stage, we're looking largely for team and market opportunity. Team mostly. We're looking for kind of super ambitious founders, complementary skill sets, people who are looking to build kind of very large businesses very quickly, solving problems that they kind of have a unique insight into. And when we think about market, we're thinking, if everything goes right, what could this look like? So it's not, what is the market today? It's what could the market become over time? How could this product evolve within this market? And so it's really if everything goes right, could this be a very large market?
And do you have a specific model that you use to quantify that? Or is that just, I guess I'm just trying to judge how much of that is quantitative versus qualitative in terms of how you assess that?
So I think there's a mildly quantitative element that would be, if your market in the best case is you win all kids between the age of 5 and 12 in New Zealand, and they're willing to pay probably $30 a year for the product. There's like a maths element there where you go, that's probably too small for a venture scale outcome that could return our fund. But if the largest market is you're solving a problem that affects all women between the ages of 20 and 40 who have this particular problem globally, or all businesses within this specific sector who are willing to pay X amount to start, and that could grow to 3x that over time. If that were to happen, that would be a $10 billion revenue opportunity. It's mildly quantitative like that, but largely there's also a story to it, which is how much could this expand the market over time?
Yeah. One of the people that I spoke to as part of the research process for this interview was Matt Keeley, who's one of your portfolio founders, who mentioned that your superpower is essentially just being really good at analytics and analysis and just really kind of understanding spreadsheets and models. He mentioned that you can do a review of a model in 30 minutes and understand a business in a way that it would take normal people much longer to get, and really sort of understanding what the multiplier effects are for those businesses to really sort of understand what are the kind of critical elements and the focus areas for that business. Again, again, to kind of unpack your process through that, can you talk us a little bit about how you sort of look at that from an investment or from a board perspective to really understand where startups should be focusing on, or which type of direction you want the founders to go into?
That's so funny that he said that, because obviously spreadsheets were relatively new to me not that long ago. I guess that's flattering. I do find now that spreadsheets are quite fun when you understand them, because they can tell a story in a way that I guess a great piece of writing can as well. And I always think, the interesting things about when you look at a company's P&L is really understanding those incredible levers of growth. What can you see in this company's P&L that shows how powerful their recurring revenue is, or how high margin it is? What's the operating leverage over time? You look at those kind of numbers, the unit economics of a business, and then you pull together kind of competitive advantage, and that's more qualitative and more of a story. How does this business become more difficult to unseat the more it grows? And those two combined are kind of, I feel like, what makes a company valuable long term. And that's usually how I think about it.
Yeah, and I guess on the flip side, for founders who maybe don't have the benefit of having you on their board or in their corner, do you have any advice in terms of how founders can sort of think about that story for themselves, in terms of when they're putting together their numbers or their spreadsheet, how they can help share that story for their own company?
I think it's quite hard when you're getting started, because you don't have all these kind of frameworks. There is a bunch of great writing on the internet now talking about, what are the metrics that matter in different types of business models. If you're in e-commerce, if you're in B2B SaaS, if you're a marketplace, you can look them up and kind of see what are the metrics that really matter in those businesses, and how do different companies lean into different elements of them as their kind of unique superpower. And what do you think you can learn from looking at those different companies and think, oh, Airbnb was so powerful because it built trust in a way that allowed people to stay in someone else's home. Or marketplaces, say StockX, that would authenticate sneakers, and actually authentication was the problem in enabling those marketplaces to exist. And so actually by leaning into that's the thing that was the unique part of that business model, and by solving that problem they built their kind of competitive advantage or differentiation over time. So I guess that's a really long way of saying, just study the best and see what they did, and see if you can kind of steal or replicate things that they did and apply it to the problem that you're looking to solve, and look online for all the metrics that matter in different business models and see how you can kind of apply them to yours.
Yeah, that kind of brings about an interesting point where I guess VCs have an almost unfair advantage in terms of them seeing so many different companies that, when you mentioned at seed stage, the most important elements for you are, the team and the potential market and the vision that they're going after. And it can be really hard for founders to get a reference point in terms of what that specifically looks like to meet that bar for investors. Do you mind sharing some examples of what that looks like, or even just some of the dynamics within the team or the market that you're looking for that gets you excited at seed stage?
So team complementary skill sets is something that we really look for. What that means is slightly different depending on the business model, but say for a SaaS business, we'd be looking for kind of product growth and technology skills within that founding team. And that could all be in one person, or that could be amongst 3 or 4 people. But we really want those people to be able to demonstrate some kind of competence or capability in each of those areas, to know that they can kind of run hard quickly and don't have to learn a whole ton of lessons that take 12 months. Obviously, if someone's doing it for the first time, there are ways in which you can show that, through conversations or through previous projects you've done, that can kind of show that to a VC. In terms of the market opportunity, I think it's really learning how to tell your story well, because I think often founders are so deep in the weeds of the problem they're solving that it's quite hard for them to zoom out. I often, when I speak to founders, I'd say kind of talk to me like I'm a 4-year-old, because you say that we have the benefit of being across loads of different companies, but we also have the curse of being across lots of different companies, which mean that largely we know very little about a lot of things. And when we meet any given founder, we probably know close to nothing about the area in which they are building their company. And so you really have to get quite good at telling your story from a kind of super high level and teaching someone almost about the industry through the conversation, so that you can say, because of this structure of the industry, there is this problem, and because of this problem, there is this even more burning problem, and we want to solve this problem in this way, and this is why we think the right route to market is this, and we think that people will pay this, and people won't churn because of this, or they will expand because of this reason. Being able to kind of tell that story that takes someone on a journey from the structure of the market and the industry all the way through to the specific problem you're solving is an art, and I think takes a lot of reps.
Yeah, and just to kind of unpack the VC model even further, one of your other partners or colleagues in AirTree, John Henderson, posted a little while ago about how a superpower for an investor is being able to come in with conviction and convince the investment committee to go ahead with the investment that one of the partners are leading. Do you mind sharing, I guess, the importance of that, maybe that storytelling piece, or even just a process that it looks like from, I guess, your meetings with a founder that you're sort of building conviction on to essentially taking it to the investment committee, and what that process looks like to come out the other side?
Yeah, I often think founders should follow up after a meeting with like the 3 things that you should take away from that meeting are. Because, John was right. Essentially, what you're trying to do as a founder is equip someone else with the ability to tell your story very well. Because from that meeting, you're getting the investor really excited. And when that investor is really excited, they have to go into a room and pitch it to 5 or 6 other people and tell your story as well as you did. And so equipping them and enabling them to do that articulately and concisely is a big part of it. Because if someone goes into that meeting and kind of waffles a bit and doesn't really get to the point, then you're not going to convince the other investors that it's a great opportunity. So yeah, as a founder, I would recommend you kind of do a follow-up email, particularly if you think the investor's keen, with the kind of 3 key points that you would try and emphasize when pitching to the rest of the partners.
And aside from those 3 key points, is there any other sort of materials or examples that you've had founders send to you that makes that process a little bit easier for you as well?
I've started to see a few founders write their own investment memos, kind of in Notion, which they share with an investor. So it really breaks it down in the way that an investor would write their own investment memo. So kind of product, market, team, unit economics, financials, competitive advantage over time. Write their version of that and supply it to the investor almost as a way so that that investor can almost copy and paste it. I don't think they necessarily would, but I think it helps someone break down the elements of the business and make it easier to kind of translate. So I think that's a good thing I've seen companies do. I'm also a huge fan of looms. If a founder sends me a kind of product demo with a voiceover on it explaining like why they've designed the product the way they have and how customers use that product at different times, I find that really, really valuable. So anything that's kind of product related to with a voiceover, I really enjoy receiving.
Yeah, and I guess kind of digging into the investment committees as well. Like I know that on the podcast we've kind of skirted around it a little bit, but speaking to a lot of founders, I know that, a lot of them don't really sort of understand what is the back room of the decision making that takes place inside a VC fund. Just from an AirTree perspective, do you mind sharing how the investment committee is structured and I guess how you sort of go about the approval process inside an investment committee to get to a stage where you decide to make an investment or not?
Yeah, sure. So our process kind of looks like someone on the investment team will have a first meeting with the founder. They'll get excited. They'll come to our weekly meeting where we talk about all the new companies that we've met. They will essentially pitch in the company. Then if everyone else is excited to kind of dig further into the opportunity, 2 people on the investment team will usually pair up and go do more work. And that will usually involve doing a product demo with the founders, asking more questions, doing some market research, things like that. And if through that research they get even more excited, they'll write an investment paper and they will send that investment paper around to everyone. And then we'll have another meeting where we'll dive deep into the company and ask a ton of questions and everyone kind of get up to speed on the company and figure out where the key areas of real opportunity are and the kind of key risks that we want to discuss and get comfortable with. And then we will usually kind of invite the founder in to meet more of the investment team. And once we've had that kind of final meeting where the founders met all the partners, we will vote. We have a kind of blind voting process straight away. So we try to remove bias that way, or like one person being loud and talking over other people or anything like that. So we all vote on whether we are a strong yes, whether we are supportive of someone else leading the investment, whether we're not supportive, or if we have a reason we're strongly against it. That doesn't often happen. And then we need 2 strong yeses amongst the partners to do an investment. So that's how we think about it. We believe firmly that most early stage investments don't look obvious. And so there are 5 partners. We only require 2 strong yeses. And that's because we don't think we should be getting to consensus to make investments.
Yeah, that's fascinating. What is the sort of nuance between having sort of full conviction and I think you mentioned having conviction as long as someone else is leading that?
So the strong yes is I would lead this deal if you weren't leading it. I think it's incredible think we should definitely do it. Supportive is more like, I get why you like it. I'm supportive of you doing it. I probably wouldn't lead it myself. And so it's 2 strong yeses that we're really looking for.
Right. And so just kind of dig into that a little bit further, because I'm just personally really curious about this. If you have 2 strong yeses, but 3 absolutely not, would that still pass based on the structure?
So we would do it with not supporters, but if someone's a strong no, then we have the ability to veto. We've never done it since I've been at AirTree, so I think it would be rare. But yeah, we could have kind of 2 strong yeses and 3 not supported.
Yeah. Interesting to see kind of the insides of how VC funds operate. Something else that kind of came up in my conversations with Matt, but also Maxine Minter, who's someone I know that you're very close to as well, is just your ability to build those sort of long-lasting relationships, particularly to Matt's point. I think he mentioned that he met you 2 years prior to AirTree taking on investment. Do you want to sort of share a little bit about how you sort of think about that relationship building exercise from a VC perspective, and potentially how founders should think about doing that in terms of when they speak to investors and how they should think about building that up as they get closer to the time when they're ready to raise?
I'm a big believer in building trust over a long period of time before you make the decision to spend the next 10 years talking to someone every week. So I am a big fan of getting to know people for quite a while before making an investment. I found it really hard during COVID not being able to meet people in real life. I think it's probably a weakness of mine that I don't think I'm great at reading body language over Zoom, and I often get a very different impression from someone in real life than I did through a Zoom call. And so I don't really like making investments with people where I haven't met the founders in real life. So I am a big fan of kind of getting to know someone over a long period of time, seeing them set goals, seeing them hit or kind of surpass those goals over time. And that really helps me build the confidence that they will continue to run fast and they will continue to set ambitious goals and hit them. So my recommendation is just get to know investors a long time before you want to raise money from them.
Yeah, and I guess from a founder perspective, it can be really hard to kind of juggle that. We want to build relationships with VCs, but not really be in a position where we're burning bridges or kind of going back to them too frequently. You know, I guess from your perspective, what are the types of ways that you would like those founders to build that relationship, especially if it's done over an extended period of time?
I usually think it's get in touch, say you're not fundraising, you just want to meet and get to know them, meet, have a coffee, ask them if they'd like you to kind of continue to update as you make progress. And then I would, update once a quarter or once every 6 months, or kind of when you have meaningful milestones with just, this is how I'm getting on, this is what we achieved in the last quarter, this is what we're trying to do in the next quarter. I think, investor update email lists are a great thing. They're a kind of really low effort way for an investor to kind of stay in contact with the business and get a feel like they really understand what's going on in that business. And so, yeah, I recommend putting together one of those. I think monthly is often not that much has happened in a month, and it can feel too frequent. So I think probably every couple of months, every quarter is probably the right cadence.
Great. Having spoken to Maxine and also having known you for quite a while, I know that you're such a large supporter of underrepresented founders and particularly female founders as well. Do you mind sharing, I guess, your perspectives and I guess what you think that we can do to help support more underrepresented founders in the ecosystem?
Yeah, I obviously think this is hugely important. We know all the statistics around the differences in both what investors look like and the people who receive the most of the money, what they look like. We're in a really fortunate position that we have a lot of leverage and share of voice in this ecosystem in Australia. And so what we do matters. We think about it in a few different ways. We think about it from kind of the representation in our team. What does our team look like? We're fortunate now to have a kind of 50-50 men and women in the partnership, a very diverse team ethically. And we kind of do things like unconscious bias training frequently to make sure that we are all aware, me included, underrepresented people included, that we all have a ton of biases and to be aware of them. We also make sure that all the programs we run, the communities we run are 50-50 men and women and 30% from minority ethnicities. And then thirdly, we've just launched something called the Pioneers community. It's designed for women who are working at startups who think they may want to be a founder one day, bringing together these super ambitious women, getting them to know each other, and then putting in front of them people who are on that journey themselves with the idea that you can't be what you can't see. So why don't we put super talented people who are already doing it in front of the women who think they may want to do it one day and let them ask all the open, vulnerable questions. We find that particularly for women founders. It's not that we aren't investing in the women founders we meet, because we track this data. The problem we really have is meeting founding teams that have women in them. And so Pioneers really for us is a long-term effort to see more women who are building venture scale businesses. We've got kind of secret targets of what we hope we hit within kind of 3 years of businesses being started. And I think that would be a huge impact if it's successful.
Yeah, absolutely. I just saw the note about the Pioneers program, which I think is a fantastic initiative. I was also very lucky to be part of the first cohort of the Explorers program as well, among other programs that AirTree runs. Is there any particular place that founders or people in the ecosystem can find out about the programs that AirTree runs?
Sure, on our website, we have all the details there. And also you can follow us on Twitter and LinkedIn, and you should be able to find information there too.
Perfect. I'll make sure I add that into the show notes. You know, when we were kind of speaking about this potential interview, one of the things that we really wanted to make sure that we got across was how investors think about potential investments. Again, one of the things that Maxine pointed out was how you in particular, when you assess deals, think about things from a perspective of looking at the bear case, the bull case, and the plus bull case, which she thought was a unique kind of lens of looking at and assessing deals. And obviously, like an example of this could be Milk Run, where you're an investor and there's been a lot of sort of conversation around that particular investment. But do you mind sharing, I guess, from your perspective, when you look at these potential deals, how are you sort of assessing them and deciding what are big opportunities that you really want to get behind? And I guess what is the VC lens when you're assessing different types of deals?
Sure. Well, I can kind of go into Milk Run specifically. When we invested, it was kind of pre-product, pre-revenue. So it really is that kind of time where we're looking at the team and the market opportunity. When you think about the team, Danny Millam, who's the founder of Milk Run, he is incredible. He's super high energy, really, really positive, extraordinary founder. Everyone loves being around him. He clearly just loves building companies, and that kind of infectious enthusiasm just comes off him. And he has great experience. He has built a consumer-facing brand before. He's built a company that has kind of operations and logistics as part of it, as kind of one of the co-founders of Koala. So we knew he had done that, and our bet was that he could build a brand that consumers loved and build a team, you know, and a company that people loved working at. And so that was our big bet with Danny. And then on the market, you know, Australia's a really interesting market. Firstly, Australians love convenience. Melbourne and Sydney are two of the top 5 cities for both Uber Eats and Deliveroo globally. And Australia is a oligopolistic market. And so, you know, the grocery behemoths just haven't had to innovate, and the delivery experience is shocking for both of them. And so there is kind of a big opportunity to deliver a delightful experience to customers in a way that is relatively unique in the developed world. And so we were betting that if you deliver a kind of delightful, convenient grocery delivery experience, you'll build loyal customers and a last mile logistics network that is unrivaled and hard to compete with. And if you have the customers and that network, you earn the right to put on the higher margin goods and new revenue opportunities over time. And so we are not betting that Milk Run will be a great 10-minute grocery delivery business long term. We believe that it will be the consumer app that people go to 3 times a week to buy stuff. What that means long term is really an opportunity for Danny to figure out, and we're backing him to be able to do that.
Yeah. And speaking of that delightful customer experience as well, I was speaking to someone about this a few weeks back, but I don't think I've seen, or I can't remember the last time that I've seen so many people put out positive experiences around a delightful experience that they had in terms of grocery deliveries as well on social media, and especially people that aren't necessarily investors in the company as well, which I think kind of speaks to the mission and what they're trying to build.
Yeah, and the marketing is just hilarious as well.
Absolutely. And final point, especially since this is now public information, but obviously delighted to have you on board as an advisor for the Playbook Angel Network, which personally, I'm super stoked about from your perspective. And, obviously having been at AirTree and kind of investing, as you mentioned, you have such a significant role to kind of play in the ecosystem. But I guess from your perspective, what is the importance of the seed stage? And I guess what more can we be doing in the ecosystem to help support founders at that particular stage?
Well, I think angels in particular are kind of the lifeblood of the ecosystem. angels are the ones who the founders come and talk to, and they are the people who help them tell their stories better, so that when they speak to VCs, they can do all the things that we were talking about earlier in this conversation. And the very best angels are incredibly well networked and have kind of really crazy imaginations, so they can talk to a founder who really just has a good idea and has no idea what to do next, and help them and kind of see their vision of the future, and then help connect them to tons of other people. And the more angels we have, the better. And I think up until the last few years, the angel ecosystem in Australia was pretty small, and largely people who weren't really well connected into startups. They were people who were just quite wealthy. And as a result, you didn't kind of have the deep network and the wild imagination. I think what's been so exciting in the last few years is starting to see people like you who have kind of incredible networks, you have founder empathy, and obviously a crazy imagination, being the people who are then able to write the checks into early stage founders and then create a huge amount of value for them as well. So it's really exciting to see. I'm stoked to be able to kind of be part of your journey as well.
Yeah, absolutely. On that note, Jax, thank you so much for coming on the podcast. For anyone that wants to find out more, say hello, get in touch, what's the best way for them to do that?
I'm at VullingsJ on Twitter, probably the place to start. And you can always send me an email, jax@airtree.vc.
Perfect. I will make sure all of these links are in the show notes. Jax, once again, thank you so much for coming on.
Thank you.
Thanks for listening to episode 169 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.